Good afternoon. My former mentor, Mike Maroney, would be disappointed in that response. Good afternoon. Anybody else work in retail? I think you remember that from a sales meeting. My name is Alan Haig. I'm president at Haig Partners. We are an M&A advisory firm to auto, truck, and RV dealers. And I've got with me three leading experts that are leading growth companies today. I'm going to spend 8-10 minutes doing a little presentation on growth and how it's going to create value for dealers. And then these three gentlemen are going to walk us through their respective plans for their companies. So first we have Tim Batchelor, who's partner with Open Road Capital, which is providing, well, I'll allow you, when we get started, to tell more about your firms. We have Rob Cochran, who's CEO of Number One Cochran, leading dealership group in the Pennsylvania area. And we have Bill Cariss, who is CEO, pardon me, of Holman Ventures, which is another leading private held company in the automotive industry. So just getting started here with the clicker that's not advancing. Oops. All right, so I started my career in automotive in 1996. I was hired to write a business plan for a company called AutoNation. AutoNation had been started by Wayne Huizinga, who's the only person I believe that's ever started 6 companies listed on the New York Stock Exchange. So very successful entrepreneur. I had recently graduated from a business school that's located about 100 blocks north of here, and I put on my MBA hat and I wrote about access to capital. I wrote about rapid acquisitions. I wrote about economies of scale. I wrote about best practices. I wrote about a national brand, and that if AutoNation could employ all those strengths, that we would become the dominant auto retailer nationwide, and we would be able to take share profitably from smaller dealers who didn't have the same advantages. So my business professors would have given me an F on this business plan. The little blue line you see at the bottom shows the market share of the largest 10 retail groups in the United States. And we grew really quickly. We went from 0 revenue to $12 billion in revenue in about 2 years. But we never really continued that growth for a number of reasons. The private cap dealers have done a little bit better. Rob's going to be talking about that too, along with Bill. And in their growth, you can see that they've been taking more share in recent years. But you say, why hasn't auto retail consolidated faster? It's still incredibly fragmented. There are very few companies that have a dominant position other than a few markets. And the reality is there are really not many economies of scale in auto retail. If I have one Ford store, I buy the same F-150 for the same price as AutoNation that has 30 Ford stores. Labor is set by the market. Used cars are set by the market. Utilities, real estate, insurance, all that's set by the market. Also, smaller operators have been able to attract and retain, I would argue, better talent. I think the managers of privately owned dealerships feel like they have more control and often can make more money working for a privately held dealership versus a public company. And secondly, the factories have resisted consolidation, partly because companies like the one that I joined grew really quickly. Sometimes we'd buy great stores and make them average. And that wasn't something that the Toyotas and the Hondas and the Fords and the General Motors really liked. So for a number of years, the factories have been using framework agreements to limit the rapid growth of consolidators. That's beginning to change. This chart shows the number of dealerships bought and sold. Prior to the pandemic, there were about 350 stores per year that traded hands. In 2021, that number doubled. Over 700 rooftops traded hands. 22 was the second best year ever in terms of M&A. Over 530 stores traded hands. So part of it was dealers just had more money to spend. There was more capital, there was more profit to reinvest in the business. But some of it was also this. The pandemic changed consumer behavior, and it advanced e-commerce in the United States by a decade. You had a company like Carvana that demonstrated that consumers would spend $20,000, $30,000, $50,000 on a vehicle sight unseen. Now, Carvana's business plan is challenged today, but companies like Lithia that have adopted a new brand called Driveway where if you go on Driveway right now, they're going to have about 50,000 vehicles in stock for you to purchase. Lithia is using their online platform to attract new consumers. They're telling us 96% of the visitors are new to Lithia. The average vehicle they're selling is being shipped almost 900 miles. So there's a market. There's a market for people who are shopping for just a certain used vehicle they want. So in my opinion, all the economies of scale that I wrote about back in 1996, what advantage did AutoNation have over the smaller retailers? This, I believe, is the beginning of the advantage for larger retailers, is that because of e-commerce, because of consumers' willingness to shop online and have their vehicle be shipped long distances, larger groups are going to be able to differentiate themselves from smaller players. Secondly, a lot of consumers are now buying almost everything with their phone. I have a son in the audience today who's 24. He's going to shop differently for a vehicle than I am. He's going to do almost all of his research online and maybe at the end go in and see the vehicle. So more and more customers as they enter their buying years are going to be comfortable shopping through a website initially and then going in to confirm their interest in person. So this strategy, referred to as bricks and clicks, is one that Lithia has adopted as well as the other publicly traded retailers. So they want to acquire a nationwide network of dealerships. I think Lithia said they want to be within 100 miles of every US consumer. And then they're going to use digital retailing, not only to sell into that core market to satisfy their customers, their AOI, et cetera, but as inventory comes back, or if they have a unit that's kind of special, they're going to be selling that unit outside of their initial AOI. And they're going to be able to take share from smaller retailers that don't have as much inventory, that don't have the same capabilities, et cetera. And so finally, this business plan I wrote about, where large scale would have an advantage over smaller dealers, may start to come to fruition. And if larger dealers can conquest sales from smaller dealers, they're going to start to please the OEMs. And the OEMs, and I know we have a number in the audience today, may begin to view larger retailers, and I don't just mean publicly traded companies. I mean the companies like the ones that Rob and Bill are running here that have dozens of dealerships located. They're going to be able to look at those groups and think, these are the ones that are providing a better experience to customers. These are the groups that we want to see grow. Lithia, Asbury, and Sonic have all talked about their revenue plans for the future. In some cases, they're talking about doubling or tripling their revenue. That's going to be coming through acquisitions. So the good news is that if you're a privately held dealer group, local scale is greater than national scale. This is a phrase that came to me from Don Flo, who's a dealer out of North Carolina, who you all know. And he said, you know, the local brands, his brand, for instance, in North Carolina, Flo Automotive, is much better known than AutoNation or Sonic or Lithia or Penske. And so the consumers, he has an advantage over those consumers in terms of his advertising. His larger inventory locally is more valuable to consumer than if he was comparing himself to AutoNation that's got 250 stores spread out across the country. He's got on his website a recruiting message that's very compelling, where he's making a commitment to somebody coming into his organization, either from high school or college, that if you join me, I will train you, I will move you from position to position, I will advance you, and if you work hard, you will be a manager in my company. That's different than larger companies that might just post a help wanted ad. Local dealers are closer to the community. We represented a family in Charlotte recently. They did some digital marketing, but their biggest advertising campaign really was about giving to the community, donating to the public schools, donating to the animal shelters, et cetera. They got so much goodwill back from that they surpassed their other competitors in the market. So, good news here is that this strategy, bricks and clicks, it's not proprietary, it's not patented. It can be adopted by any retailer in this room or outside this room. The key is to grow. The average dealer today has got 2 stores. In my opinion, that's not enough to offer a breadth of selection to consumers. It's not enough to have the best technology. It's not enough to have the best management. We've done some modeling that says that if the average dealer today takes all of his cash flow and reinvests it over the next 10 years, he can grow from 2 stores to 10 stores. That's going to allow him to build a strong brand, to have the inventory, to attract and retain top talent. And so we believe that smaller dealers today shouldn't feel threatened by consolidation so long as they're participating in consolidation. So this evolution from being a dealer to being an investor is what we think is going to be necessary to thrive 10 years down the road for our dealer friends. We've done a little math here. There's too many numbers on here to point to, but if you want to later, I can share the math that shows how you go from 2 stores to 10 stores. What's the reward for this? Well, the first is you prevent your business from declining in value. If you stay at 2 stores, if you don't grow, if you don't have what the customer really wants today, then I think you're going to suffer, and I think the value of your business will decline. If you do grow, of course, you're going to have higher cash flow, and you're going to be able to maximize your value if you decide to exit 10, 20 years down the road. So to sum up, I think that the future belongs less to people that inherit a business from their parents perhaps, and for those that are going to go and create their own empires. With that said, I'm going to ask our first panelist here, Tim, to go ahead and introduce yourself and your company.
Thank you, Alan. My name is Tim Batchelor. I work at Open Road Capital, and Open Road runs a partnership model. We have 5 partnerships across the country, from Mississippi, Connecticut, 2 in Canada, and 1 in Iowa. And we partner with dealers, such as Alan's suggesting, that want to grow faster. Sometimes it's younger dealers that want to grow faster than their cash flow will allow them to in terms of acquiring other stores. Sometimes it's families who are in transition. You may have a son or a daughter who are running a group, and mother or father has retired, just got siblings that are not in the business, and they want to sort of consolidate ownership and have a more active, constructive shareholder involved rather than just clipping coupons for the family members. Or a combination. Sometimes there's larger groups that want to take some money off the table, find diversification, and want to continue to run their stores. And we do have them run their stores. We don't tell people how to run stores. That's why we're picking good partners, and that's our primary purpose. Pick good partners that know how to do things better than we know how to do, and then help them around the edges, whether it's on real estate or financial reporting, technology, some of the stuff that scale can bring.
Rob?
Thank you. So I'm Rob Cochran, President and CEO of Number One Cochran, a Western Pennsylvania-based dealer group. We have, depending on how you measure it, 26, 27 different stores in a very concentrated geography. We go as far east as Johnstown, Pennsylvania, and we just went, just a couple months ago, we migrated into the state of Ohio for the first time with 2 stores in Youngstown. We also have 11 collision repair facilities. Collision repair is a key part of what we do. We have a big wholesale parts, a centralized wholesale parts depot that feeds the collision repair business. So we really work on everything within that defined geography that a customer could want.
Bill?
Thanks, Alan. Good afternoon. Bill Cariss, I'm with Holman. Holman has a group of dealerships. We have 35 dealerships, way different than Rob. We're spread out all across the country in 8 states. So we go down to Southeast Florida, then we go up to the state of Washington in Seattle. Many of you know we acquired, it's hard to believe it was 6 years ago that we acquired the Cooney stores, which that took us out to the west coast of the United States and really rounded out our platform. As Alan was asking me just recently, you guys looking to grow again? And the answer is yes, we are looking to grow again. Cooney was a wonderful acquisition, wonderful people. We would do it again and again and again. We're thrilled with it. Takes a little bit to let the dust settle in, and yeah, we're back in growth mode right now and looking forward to that. Some of you might not know the other businesses we run, so we have quite a large fleet management company, ARI. We call it Holman Fleet now, so we have just under 2 million vehicles under lease or management. We balance sheet a large share of those vehicles as well, and some of our brag names are FedEx and Comcast and Burlington Northern, some of those large fleets. And then the third thing we do is we upfit trucks for some of those railroads, for some oil patch customers, for the Chicago Police Force. Unfortunately, they wreck a lot of cars, and then we build them back up for them. So we have 11 plants across the U.S. For them.
Rob, you mentioned you have a geographic strategy concentrated in an area. Can you talk a little bit about how much capital you intend to invest in acquisitions over the next 10 years? Do you agree with this get big or get out type of strategy or challenge that dealers face today?
Well, I think every dealer needs to make the decision that is best for them. I don't know if there is, the question of strategy, right? There are people, peers of mine within this industry that have a strategy that is markedly different than ours and are wildly successful with it. So to me, the question of strategy is defining your uniqueness, where you gain your benefit for the customers, because ultimately the customers are going to choose the winners of tomorrow. For us, the defined geographic market has worked well for us. Pittsburgh is a market with not a lot of transients, so that the people, we've been doing this for, our company's 58 years old now. Many of those people have grown up with the Cochran name, their grandparents, their parents, and now them, and hopefully their children. And so we built around our name and our brand. We're very brand-centric, and that's why the temptation, if you will, to move 4 hours, 6 hours, 10 hours in a different direction, we've resisted that temptation within Western Pennsylvania. So our strategy is a gently expanding geography with the acquisitions into Youngstown now. But as in that defined geography, offering whatever it is that the customer wants. We want to be, whatever the product is, whatever the service is, if it refers to vehicle transportation or personal mobility, we want to be the liaison with that customer. We want to be the concierge for that customer and develop long-term relationships with them. It also has an impact certainly on the people. There's less management risk with how we do things because everybody's closer. We can promote younger people in the system. We just last month we announced a partnership with a local tech school to help feed the technician pipeline for our companies and all the dealerships in the coming years. So there's a lot of synergies, and I think we've just tapped. There's a whole lot more that we can do. I think there's some scale advantage, and I believe by looking at the business differently, there can be more scale advantage gained in the years to come.
And you've got a strategy that's not so much focused on geography, but maybe based upon brand. Can you talk a little bit about that in terms of luxury, perhaps?
So we like to take our operating businesses through formal strategy processes, which can take upwards of 8 or 9 months. We spend a lot of time on that. And what was really just reaffirmed, and I would say just we put a finer point on, were the states where we want to operate. So it is geography and brand. We did what probably most of you just do just by reading, but we actually went state by state and we said things like, what are state franchise laws, NADA? How strong are they there? Is it a right to work state? Is it, all these things? What are dock fees? All the things that we as dealers, it helps us be able to provide a better service to our customers because of the grosses that are there. So we went state by state, and then we also went brand by brand. And so the juxtaposition of those is really what we are intentionally looking at, but then obviously, as you know, Alan, there's opportunistic, the ones that are inbound versus outbound, and somewhere in the middle of that is where growth occurs. So, yeah, we're very intentional about where we want to go moving forward.
Do you have a target for how much capital you're interested in investing in the next 10 years, say, on the retail side?
Yeah, we do.
You don't have to share it if you don't want to.
I don't think I should share that, but obviously we as dealers have had just a wonderful run here, and we're blessed to work for a family that reinvests all the capital back in the business. So to keep our returns where they need to be, when the denominator grows, the numerator's got to grow by a lot more than that, by 10 times to get the returns we want. So we did financial engineering. It's not super sophisticated, but we know what we need to make, bottom line, to support returns. And so what does it cost then to acquire those stores? There's not a whole lot of great open points out there. We'll take them if they come our way. But yeah, we know where we want to go from an acquisition standpoint to get there.
All right, so Tim, you're really more operator focused on your investments.
Yep.
And those types of investments, are they local, broader, brand? How would you describe the investments that you make?
Well, we're brand agnostic. We're geographically agnostic. We know that cities like New York City are very difficult to make money in unless you're subsidized. Most of these stores are subsidized by the manufacturers. So it's hard. Inner city real estate is a problem. But other than that, very rural areas are hard to grow and attract talent. And the world's our oyster beyond that. And brand-wise, there's some brands that we're not targeting, but if they come with a group, we're happy to bring those along. And back to your question about scale, which I'm sure there are people in the audience, there are smaller dealers and larger dealers. And I wouldn't say that a smaller dealer has 2 or 3 stores is going to be driven out of business because they don't have scale. There is opportunities to make more money possibly by being larger. Brand diversification within your geography makes sense because some brands are up, some brands are down. So there's reason to. But I agree with Rob that it's what's right for you. And scale is not right for everybody. It's not what they're looking for. But I think it did bring to mind our partner out in California, Rinaldi Halim. He came here when he was 10 years old. He didn't speak any English. He went to work eventually for Nissan. He ended up with 10% of the Nissan store. His area managers for Nissan moved over to Chrysler, and they had the downtown LA store that was losing money perennially, always lost money. They talked him into investing all his money that he got out of Nissan, put it into Chrysler, turned it into making $2-3 million a year. And then another fellow sold his Chrysler store to Rinaldi that wasn't losing money, but it wasn't making money. So now Rinaldi was in his own business. He owned 100% of it. And he was doing great, making $3 to $6 million or more a year. And then he found out that same fellow that sold him the Chrysler store was selling Honda, Subaru, and Chevy. And he could have just clipped coupons with his Chrysler store and been perfectly happy and perfectly well. And in a few years, he could have bought another store and another store. Eventually, he could have a few stores. But he called us, and we partnered with him. We bought those other 3 stores. He put his 2 Chrysler stores in at full value. We put in the cash to buy the other 3 stores. And the equation there is that he's a better operator than the guy he bought. Like, these guys are better operators than all the people they buy. And he'll double the profit. He's already doubled the profit of those stores. And so he's doubled his value that he transferred at a tax-free basis into those other 3 stores. And his net worth has doubled. Then with our own cash flow, we bought Felix Chevrolet, an iconic brand down the street from us. And we're about to close on another deal, and we were awarded a Subaru Open Point, which is arguably worth a whole lot of money. So I'd say Rinaldi's net worth is quadrupled in a year and a half. And that's what he wanted. He sees himself as a bigger dealer. He wants to have 15, 20 stores, and he will in our partnership. But if he had been satisfied with owning 2 Chrysler stores, he'd have had a great lifestyle. And so I wouldn't say it's right for everybody.
So there have been a lot of discussions and people up here talking about changes between the OEM relationship with the dealers, everything from EV architecture, agency model, over-the-air updates. Some of those changes I know have concerned some dealers. When you guys think about the future and investing in auto retail, how do you factor those into the existing business model, how it might evolve? And then what do you think these stores are making in 5 years?
Hopefully somewhere close to what we're making today.
Okay, so
I think we'd all sign up for that.
We would sign up for that. What do you think?
So first of all, your first question, how do we factor that in? I'll just speak from a capital standpoint. We look at the payback period, and the payback periods right now are pretty strong. So we believe that the franchise system is going to be alive and well for at least 5 to 8 years, and some of these paybacks are 5 to 8 years. So just from a flat-out financial engineering standpoint, that makes sense. We're privately held, but we still hold ourselves to rigor of financial discipline. So that's more from a dollars and cents standpoint. From more of the where is the industry going, people have talked about the agency model, people have talked today about selling direct with EVs. We continue to believe, and this sounds, somebody used the word Pollyanna-ish early, but we continue to believe that the good manufacturers are going to see the value of good dealers. And so what does that mean? It means we need to be a phenomenal dealer. And I know Rob feels the same, and just met Tim, feels the same. A friend of mine, John Berkshire, once said, we need to make sure that every day when we turn the key to our stores that we bring value in the supply chain. And I think about that all the time, and we talk about that all the time. Thank God for NADA and state groups that work to protect our franchise rights, but we need to be great dealers. And we believe if we are, the good manufacturers are going to work with us. It might be a little different. The agency model's out there. We at Holman, we don't want somebody in between us and our customers. We don't like that. We would rather retail directly to the customer. If it happens, we'll see what the manufacturers pay us. We intend to stay in the dealer business if that happens. But for right now, we need to be great providers. And we think the manufacturers, there's a lot of smart people there. Thank God for Jeff and what Jeff is doing. I love what he said in his speech. Just talk to us. We want to be your partners. So I love that thought from Jeff.
Rob, how do you do the calculus?
Well, I will, as far as the dealer OEM relationships and the risks down the road, I'd put my NADA industry relations hat on, which I've had the good fortune to be in that position over the last year or so. And I've been involved in a multitude of dealer OEM, dealer attitude survey sessions. And while there is tension, and the tension to acknowledge the tension is important, I think Mike Stanton, his op-ed in Automotive News just last week was really well done and on point. And we acknowledge the tension, but in large regard, the communication and the dialogue between the dealers and the OEMs has been very, very good. The commitments that we've received from the OEMs on the franchise systems has been heard, at least from my standpoint. We've heard it, and there's always, as the editorial speaks about, somebody on the fringe, an OEM says something or doesn't say something, and it creates a stir. It creates a ripple effect, which it needs to. But we also need to acknowledge that most all of the OEMs are working with us. So that being said, from my standpoint and from number one Cochran's standpoint, we're bullish on the future. There's going to be change, and from our leadership and our management, one thing that I talk about a lot is that we need to be nimble. We need to be ready to pivot. We can't be anchored into the ways that we've always done things, because we're going to need to do things differently. We're going to need to react to what the customer wants, digital retail, whatever that includes, certainly getting involved in embracing the EV wave and trajectory. But to the point just made regarding this 5 to 8 year outlook, I agree with that the paybacks on good acquisition should be absorbed between that period of time. What happens 10 years down the road? I don't know. We're not looking out quite that far, but I think in the medium term there's a whole lot of headway for us.
Spoken like a true entrepreneur. Respond to what the customer wants. I like it. Sam, you're representing a large amount of institutional capital. Some of the smartest people in business have placed that capital in your hands to invest. Do they ever waver when they pick up Automotive News and they hear about proposals from different OEMs about continuing to put money into auto retail, or are they excited by the returns they're getting today and expect that to continue?
We discontinued their subscriptions to Auto News. They just don't know it. No, I think everybody has a rational view that we share with Bill and Rob, and I'll also take the opportunity to thank Mike and Andy and Todd and Catherine and some of the other people that I haven't seen from NADA yet, but they're doing such a fantastic job. And if not for them, I think the industry would be threatened. I think it's due to their efforts that we're probably not threatened, but threatening. The agency model is one that is a slippery slope, and it really, to me, it's all about who owns the customer. And if we don't own the customer, then who's going to own the F&I profit in 5 years? And so I think it's an important line in the sand to hold. On the other hand, I'll say, you know, our dealer partners are kind of okay with the agency model to the extent that we can, you know, we'll end up with lower margins, but we'll also, it's accompanied by lower costs. And if that balances out to a net equal or a net positive, that's fine. It's when, you know, there's a lot of chips on the table and you start moving chips around, and if we end up with less chips, that's a problem, particularly since we are all investing in the facilities, that implicit contract we have with the manufacturers. That's not fair. But I'll also say I'll give a shout out to the manufacturers for a second, because I, from a consumer standpoint, have personal experience with knowing where they're coming from. We don't own any dealerships in the DC area where I'm from. I had to buy a vehicle for my kids. And so just like any consumer, I went online, I looked, and there was one, I don't remember what the cost was, something like $25,000, let's say. And they had a line through it, and it said $23,000. And so I emailed them like it said to, and I said, is this the out-the-door price? And I got a response back from the salesperson that says, it's not the out-the-door price. You have to come into the dealership and get the out-the-door price. And I said, I'm not coming into the dealership. What's the out-the-door price? The out-the-door price is $27,500. So I said, so you start at 25, you mark it down to 23, and then you mark it back up to 27.5. I said, by email, I said, why don't you mark it down to 20,000 and then mark it up to 30,000? Or better yet, why don't you mark it down to 10,000 and mark it to 35,000 when you get in the store? I didn't get a response. Can you believe that?
Have you since acquired this dealership?
Well, if we did, we'd change it. So we have to leave. But the point of it is that there may be dealers in the room that would never do that. There may be dealers in the room that don't mind that. But I think this is a problem in our industry, and it gives license to the manufacturers to want to own that relationship, because they spend a lot of money promoting their vehicles, brand equity, and all of that, which can be destroyed at the retail level very quickly. So I think it's also incumbent upon us as a dealer body to weed out these practices and be the most ethical, good practices that we can have.
Well, on that note, I think we're out of time, so I'm going to ask the audience to please give our panelists a big round of applause.
Thank you, Alan.